It was a Friday night. Families poured into Red Lobster across America, drawn by the promise of endless shrimp, buttery biscuits, and the comfort of a place they had grown up with. The lights glowed warmly, the chatter was lively, and everything seemed normal. But behind the doors, something far darker was happening. Red Lobster, the beloved American dining icon, was drowning in debt, struggling to pay employees, and quietly closing restaurants without warning. This wasn't a result of poor marketing, a failed promotion, or changing tastes. This was deliberate, calculated, the work of Wall Street vultures who had turned a national treasure into a cash cow for themselves. This is the story of how Golden Gate Capital, a private equity firm, looted Red Lobster, leaving behind a trail of human cost and shattered trust. To understand the disaster, we have to go back to 2014. Red Lobster was a thriving brand, part of the Darden Restaurants empire, alongside Olive Garden and other household names. It was profitable, loved by millions, and a source of stable employment for thousands. Then Golden Gate Capital entered the picture, a private equity firm known for aggressive acquisitions. They saw Red Lobster not as a place where families gathered or where employees built careers, but as an opportunity to extract massive wealth. Their strategy was deceptively simple: buy the company, sell the land it occupied, lease it back, and drain the business of cash. This tactic, known as a sale-leaseback, is a favorite of private equity. It generates immediate cash for investors while saddling the company with long-term rent obligations, often higher than before. Golden Gate didn't just buy Red Lobster, they bought its real estate. Every restaurant location became a source of income for Wall Street, not for the staff, the customers, or the communities that had supported the brand for decades. The crime. Wall Street's greed. Golden Gate Capital paid $2.1 billion to acquire Red Lobster. The headlines celebrated the deal as a major investment move. But behind closed doors, the real work began. Step 1. Sell the land under the restaurants. Each property was sold to outside investors, often at inflated values, and then leased back to Red Lobster at high rates. Suddenly, a company that once owned its buildings outright now had rent bills that consumed millions annually. Money that had been reinvested in kitchens, staff, and menus now flowed directly into Wall Street pockets. Step 2. Operational budgets. With more money tied up in rent, Golden Gate cut corners wherever possible. Maintenance budgets were reduced, kitchens were underfunded, and staffing levels were trimmed. The quality of food and service, once the brand's backbone, began to erode. Restaurants looked tired, and employees felt the pressure of impossible workloads. Step 3. Load the company with debt. Using financial engineering, Golden Gate borrowed heavily against Red Lobster's assets. Revenue that used to grow the business was now siphoned off to pay interest on loans and satisfy investor demands. Every plate of shrimp, every basket of biscuits, was now indirectly paying Wall Street, not the staff or suppliers who made the meals possible. The result was devastating. A once thriving brand was hollowed out, stripped for profit, and left to stumble under a mountain of obligations. The human cost, victims of the heist. This isn't just a story of numbers, it's a story of real people whose lives were disrupted. Employees were the first to feel the impact. Servers who had spent years building rapport with regulars suddenly found their hours cut. Chefs who had spent decades perfecting recipes were let go. Managers faced impossible pressure to make the numbers work while maintaining a dining experience that had been stripped of its resources. Then came the restaurant closures. Locations that had served as gathering places for local communities were shuttered. Families who had celebrated birthdays, anniversaries, and graduations at Red Lobster now found empty lots where laughter once echoed. And the customers, millions of loyal Americans, began to notice subtle changes. Shrimp platters were smaller, biscuits weren't as fresh, service slowed. The environment that had once felt welcoming and reliable was now worn and inconsistent. Golden Gate's financial maneuvers created a chain reaction. Employees suffered, restaurants declined, and communities lost more than just a dining option. They lost a piece of their cultural fabric. The distraction, endless shrimp and media spin. Some blamed Red Lobster's endless shrimp promotion for the decline. Critics argued that giving away shrimp for a fixed price was unsustainable, but that was never the real issue. Endless shrimp was a marketing tactic designed to bring in customers. It didn't drain the company. The true problem was the calculated extraction of wealth by Golden Gate Capital. The promotion was a distraction, a way to focus public attention away from the real crime, a private equity takeover that prioritized investor profit over human lives and brand integrity. This is a pattern repeated across countless American brands. Attention is shifted to surface-level issues while the structural exploitation happens silently in boardrooms. Red Lobster was a textbook example: collapse and sale. By 2017, the consequences of Golden Gate's strategy were clear. Red Lobster was overburdened by debt and rent, struggling to maintain operations and losing market share. Employees were burnt out, locations were underperforming, and the brand's reputation was faltering. In 2020, Golden Gate sold Red Lobster to another investor group. Reports suggest the sale price was roughly $2 billion, essentially recouping their initial investment while keeping the massive profits they had extracted through rent, debt, and operational cuts. The company itself, however, was left weaker, burdened by long-term obligations and struggling to reclaim its former glory. The brand survived in name, but much of its spirit, its stability, and its culture were casualties of financial exploitation. How private equity preys on iconic brands. Red Lobster's story is not an isolated incident. Private equity firms frequently target well-loved brands to strip them for parts. The pattern is consistent. 1. Acquire a profitable, recognizable business, often with valuable real estate. 2. Extract as much cash as possible through sale-leasebacks, debt loading, and operational cuts. 3. Leave the business weaker. Service declines, employees suffer, communities lose a trusted brand. 4. Flip for profit. Sell the company after extracting maximum value, leaving the next owner with a hollowed-out shell. It's a system designed to prioritize investor profit over people. And Red Lobster was caught squarely in the crosshairs. The human face. Imagine walking into an empty Red Lobster where laughter used to fill the room. The familiar smell of baked biscuits is gone. Employees who once prided themselves on their work are no longer there. Families who celebrated milestones here are left with memories that feel tinged by loss. This is the true cost of Wall Street greed. A human and cultural toll that can't be captured in quarterly earnings reports or investor newsletters. Behind every financial maneuver, there are real lives affected. Behind every profit margin, there is a community left worse off. Red Lobster wasn't destroyed by bad marketing or consumer disinterest. It was systematically stripped for profit. Its decline was engineered, deliberate, and profitable for a few, devastating for many. The story of Red Lobster is a warning. It shows how Wall Street, in the form of private equity, can prey on the brands we hold dear, turning them into instruments of profit, while ignoring the human and cultural cost. Next time you see a beloved company struggling, remember, the culprit may not be poor management or a failed promotion. Sometimes it's a boardroom thousands of miles away, focused solely on short-term gains and investor payouts. Red Lobster survived, but at a cost. Employees lost stability, communities lost gathering places, and customers lost a piece of their cultural fabric. And the lesson is clear. When Wall Street vultures come, even the most beloved brands are not safe. If this story shocked you, hit that subscribe button. We uncover the hidden truths behind beloved brands, exposing the human cost of corporate greed. Don't miss our next investigation. You'll never look at your favorite restaurants the same way again.